The crypto market is putting in some wild moves, and everybody is watching price charts or ETF flows. But meanwhile, in the shadows, governments around the world are gearing up for a New Year crackdown on crypto with rules and regulations that will change the industry forever. So, in this video, we're going to give you the rundown on exactly how things are changing in 2026, what that means for you, the crypto user, and what that means for the crypto market. My name is Guy, and if you care about the future of crypto, this is one video you can't afford to miss. First up though, I must make one thing clear. I am not a financial advisor and nothing in this video should be considered financial advice. This is purely educational content meant to inform you about the looming regulatory crackdown on crypto. If that sounds interesting, or indeed terrifying, hit that like button and let's get into it. So, countries around the world are stepping up crypto regulations. But how exactly? Well, let's first look at what's happening for the UK, dear old Britannia. From the 1st of January 2026, crypto exchanges, brokers and custody-style platforms serving UK customers will start collecting detailed user transaction data. And that data will be handed over to His Majesty's Revenue and Customs, or HMRC, the UK's tax authority. For UK traders and investors, that means your name, date of birth, home address, country of residence, and even your national insurance number or unique taxpayer reference. Then, for each transaction, they want things like the value, the asset, the type of transaction, and the number of units. And this isn't just a passive store that data somewhere operation. Platforms have to file an annual report to HMRC, with the first one due by the 31st of May 2027, covering everything that happened in calendar year 2026. If a platform doesn't report, reports late, or sends a mess that's inaccurate or unverified, HMRC can slap penalties of up to £300 per user. Yes, per user. So, UK users can expect to receive requests from their exchanges for all manner of KYC details, if they haven't been provided already. Now, the UK didn't wake up one morning and randomly choose to crack down here. This initiative sits under the OECD's Crypto Asset Reporting Framework, or CARF, which is technically about cross-border tax transparency. However, the UK government explicitly decided to extend their effort to cover domestic reporting of UK resident customers too. That means it's not just money leaving the UK that gets attention. To be clear, platforms collect details from all their users, but they only have to report to HMRC for UK tax residents, or for residents of other countries that have signed up to the same OECD framework. In other words, this is designed to plug into a wider network. Widening the net gives HMRC visibility over both domestic and cross-border crypto activity, ahead of the first big international information swaps planned for 2027. More on that later. Meanwhile, across the channel, the European Union is determined not to be outdone on the surveillance side of things. And the EU isn't doing this with one rule, but instead focusing on stacking identity, licensing, and tax reporting. So, let's first look at identity. The European Commission says every member state will offer an EU digital identity wallet by the end of 2026. So, instead of uploading a passport photo, users will be able to log in with a state-issued digital ID wallet, and exchanges will be able to plug that straight into their KYC measures. However, that means a digital ID will forever be tied to transactions associated with that account, as well as any of the self-custody wallets that interacted with it. And that last part is thanks to a rule already in place that laid the groundwork for this new global system in the making. And that brings us to transfers. If your crypto moves through a regulated platform, EU regulators want to know all about it, which is why there has been a strict implementation of the travel rule across the Union. This rule now applies in major economies worldwide, setting expectations for what information should accompany certain crypto asset transfers. Now, practically, in case you're not already familiar, this comes up as extra questions at the worst time, right when you're trying to deposit or withdraw. Is this your own wallet? Who's the recipient? What's the relationship? If that sounds invasive and frustrating to deal with, well, that's because it is. And then we have taxes. DAC 8 is the EU's implementation of CARF that we mentioned earlier. The European Commission's timeline states that countries must transpose it by the 31st of December 2025, apply it from the 1st of January 2026, and 2026 is the first reporting year. And to be clear, it's not meant to be EU platforms only. If a company serves EU residents, the EU wants a route to pull that data in. The DAC 8 framework has been in development for years and was always intended to target entities globally, not just those within the EU. And finally, there's the EU's licensing system, MiCA. Firms operating under national rules before the 30th of December 2024 may keep operating until the 1st of July 2026, or until they're granted or refused authorization. It gets messier still, as some countries can shorten the grace period, which European regulators track in a grandfathering list. But we won't get bogged down in that now. The bottom line is that all countries and businesses will, eventually, have to fall in line. Now, to be fair, there is some upside here if you're inclined to stick with trading on centralized exchanges. These rules will mean fewer rug pull exchanges, better custody standards, clearer compliance processes, and less of all the other FTX-style nonsense. So, whether you're going to trade on centralized exchanges in this new world, or you prefer to trade on decentralized exchanges instead, you might as well not get rinsed on fees while you're at it. And if that's you, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get these offers, all you need to do is hit the link in the description or scan this QR code. And once you get on the deals page, find a deal that suits you, click one of the Sign Up Now buttons. These deals won't be around forever though, so take advantage of them while you can using the link in the description below or the QR code on the screen. Now, so far, we've looked at the UK and the EU cracking down on exchanges to monitor crypto users. But what's happening in the US? Well, across the Atlantic, users are more immediately concerned about something arguably more serious: debanking. Picture this. You've built a legitimate business, you talk compliance and mainstream crypto adoption, and your bank still hits you with an email stating they're booting you as a customer. That's basically what happened when Jack Mallers, the CEO of Bitcoin-focused financial platform Strike, said JP Morgan closed his personal accounts. If someone that high profile can get iced out, well, it tells you the real gatekeepers in the US aren't the exchanges, but the banking system. And this has been a harsh reminder for US crypto users, and indeed the rest of the world, that having a perfectly compliant setup isn't necessarily enough. If your bank won't wire money to an exchange, or your exchange can't keep a bank account, well, the whole thing falls apart. Now, crypto natives have named this broader pattern as Operation Chokepoint 2.0, the claim that regulators have for years been using banks to crack down on crypto by treating it as a liability. Republicans on the House Financial Services Committee just released a report reviving that label while arguing federal banking agencies leaned on firms to de-risk crypto. Now, whether or not you buy the idea of a coordinated campaign, the outcome was and is the same. Banks de-risk, which is a polite way of saying they're giving you no account, no card, no payroll, and no fiat on or off-ramp. For retail, it's random transfer bans and frozen accounts. For companies, it's simply not being able to operate. But there are other pressure points looming in the US as well. For all trades made in 2025, brokers and exchanges are going to report customers' digital asset sales to the IRS, similar to what's set to be implemented in the UK and EU. Those forms start landing in early 2026. And that means exchanges will hand the IRS a clean list of what users sold, when they sold it, and for how much. So it appears privacy is also under pressure in the US. Now, at first, these forms have focused on the sale amount, basically how much money you got when you sold your crypto. They haven't had to include your basis yet, which refers to what you originally paid for that crypto. But once basis gets added into the mix, everything changes, because now the IRS can do the full maths on its own. They don't just know you sold, they can automatically work out your profit or loss without needing you to fill in the blanks. Although they'll still ask you to calculate everything yourself just for fun. So, for US crypto users, this likely means more mismatched letters, more automated notices, and more people finding out the hard way that tax season is the least fun time of the year. Brokers and exchanges are now logging everything, and the IRS is always watching. On a separate note, there was recently a push to drag DeFi front ends into broker reporting too, the so-called DeFi broker rule. But Congress killed that expansion earlier this year using the Congressional Review Act, basically the fast-track option for wiping out a federal rule. So for now, most DeFi interfaces aren't expected to crank out tax forms they're structurally incapable of producing. Now, of course, the general backdrop for crypto in the US is a more favorable regulatory regime under President Trump. That's certainly true when compared to the EU, for example. Still, most people touch dollars at some point, and the US is cleaning up the dollar side of crypto, all while overzealous regulators continue to crack down on high-profile individuals who are seemingly doing everything right. Now, you've probably noticed a bit of a trend here, that major economies are taking similar approaches to tightening certain crypto regulations. It almost seems coordinated. And well, that's probably because it largely is. The engine behind this is that OECD initiative we mentioned earlier, the Crypto Asset Reporting Framework, or CARF. This tells crypto platforms what customer and transaction info they need to collect, so tax authorities don't have to play detective. Now, the OECD argues that CARF exists because crypto can let money slip past the older reporting system when activity moves out of banks and into the crypto ecosystem. And 2026 is the big year that sees this system start. The OECD's latest CARF commitment list shows a big group of jurisdictions aiming to start exchanging CARF data in 2027. So 2026 becomes the first big capture year, and 2027 is when the cross-border file swapping starts. And it isn't just the EU and the UK. 27 jurisdictions are lining up to join in 2028, including Australia, Canada, Hong Kong, Singapore, and the UAE. Currently, the US is set to undertake first data exchanges in 2029. However, it may end up joining sooner than that, subject to legislative procedures. So, what does this look like for you in real life? Well, your exchange or broker compiles a yearly report of your activity, attaches it to your identity, and sends it to the tax authority where you're considered resident. So, if you've got accounts across borders, those reports can be lined up against each other. And if your tax return doesn't match what the platforms reported, that's when you get the fun surprise: emails, questions, and deadlines to explain your activity. And don't assume this only hits full-time traders. One swap you forgot about, paying for something with crypto, bouncing coins between platforms, even just keeping sloppy notes, any of that could create gaps between what you report and what gets reported about you. As it happens, we've already seen some signs as to where all of this is headed. In the UK, HMRC sent nearly 65,000 nudge letters in a single tax year to people it suspected weren't reporting crypto properly. And sure enough, the new CARF-style reporting coming in 2026 will give HMRC easier access to exchange data. What crypto is left with are fewer gaps and more automated follow-ups. For exchanges, the effects will be considerable. Compliant exchanges become either the safe default or the only option, as the grey stuff gets harder to access from normal bank accounts and most countries. And in relation to users, they can expect to be geo-blocked from more exchanges that don't comply with local regulations. Another element here is that smaller exchanges will likely find it harder to remain fully compliant, as these systems can be costly. If you've ever seen large crypto businesses advocating for stricter regulations in certain areas, this might be part of their rationale. So, that's just to say that we may see a shake-up in the crypto exchange sector over the next few years. This all might make crypto more institution-friendly, but many argue this means we're drifting ever further away from the traditional crypto ethos. So, it's clear to see that these new rules and regulations will change the crypto landscape. But what kind of impact will this have on crypto markets themselves? In crypto, centralized exchanges have been more than just trading venues. They have practically been the default home for retail crypto. People continue to park coins there for months or years, using them like personal wallets, and have even treated them as de facto bridges to move tokens across chains. However, it's not hard to see why this might change when people realize that every centralized exchange, or CEX transaction, is being monitored while pinning a digital identity to a user's actions. And where might that liquidity go? Into self-custody. Now, that doesn't mean everyone becomes a hardcore on-chain purist, but it does mean more people will be pushed to go more crypto native. And needless to say, this is where decentralized exchanges, or DEXs, stand to benefit. On-chain will begin to look all the more attractive if it offers more relative privacy by default. We've already seen periods where DEX market share surged versus CEXs, and this pattern may repeat with gusto as new CEX monitoring systems fire up next year. Recent analysis from CoinGecko showed that the DEX to CEX spot trading ratio has soared over the past 5 years, rising from just 6% in January 2021 to 21% by November 2025. Notably, that ratio peaked back in June of this year at over 37%. The next phase of that isn't necessarily that DEXs replace CEXs, but DEXs are in a good position to steadily take more and more market share as they've proven they can. And if that trend continues, the biggest winners tend to be the venues that feel like a Binance in terms of UX while still being on-chain. That's why the latest generation of perp DEXs, which also offer spot, have become such a huge narrative. Hyperliquid is the poster child here, but there are several great venues out there now as the space grows more competitive. Traders have shown they are happy to migrate if the platform offers speed, leverage, and liquidity on a par with centralized venues. And if these DEXs continue taking real share, the market is likely to favor tokens linked to that flow. In that scenario, tokens like Hype and Asta are basically bets on whether on-chain trading keeps eating the lunch of centralized exchanges. But of course, none of this is guaranteed, and it's definitely not risk-free. DEXs still have smart contract risk that is unique to each platform, as well as putting the security responsibilities of self-custody squarely on the user. Also, front ends, teams, and ecosystems may still end up facing more regulatory scrutiny further down the road. Jurisdictions worldwide are still deciding exactly what to do with DeFi, DEXs, and tokens more broadly as the space evolves. So, DEXs can gain share and some DEX-linked tokens can thrive, but it's not 100% clear where regulations will fall in the future. Then you've got the other corner of the market that has something to offer as these new monitoring rules kick in: privacy coins. Coins like Monero and Zcash exist to keep on-chain details private. Obvious appeal in a world where governments are stepping up their efforts to monitor your every move. But the same thing that makes privacy coins appealing to users can make them radioactive to regulated platforms. Binance and other leading exchanges delisted Monero in February 2024 due to regulatory concerns. It could therefore become harder to trade these coins as big exchanges back away from anything that makes compliance difficult. So, while privacy coins can pump hard, as Zcash recently demonstrated in glorious fashion, they also carry liquidity and exit risk as the list of easy on and off ramps shrinks. Then there's the privacy tools sector, mixers, coin joins, and other ways people try to stop on-chain analytics from building a perfect profile of their wallets. And users don't need to be doing anything illegal to want that. They might just not want their salary, savings, trades, and spending to be one public dossier. Nonetheless, the market impact here could be messy. If more people reach for these tools, regulators may end up treating the entire category like a red flag, as they already have been, more or less. That could result in stricter exchange policies, frozen deposits, and legal risk for developers and operators. Big picture, it seems as though the market may be about to split into two lanes. One lane is regulated and friction-heavy, but it's liquid, easy, and increasingly approved by institutional capital. The other lane is smaller, more technical, and a bit more chaotic, but it's where most of crypto's original spirit lives, along with more potential for bigger gains. But, just to be clear, both lanes can grow at the same time, and they can both create winners. So, that's the outlook for the oncoming crypto crackdown and how we think it'll impact the market. But what do you think? Are governments overstepping? Will this possibly reinvigorate the cypherpunk spirit? Or will people opt for the safeguarded forms of crypto instead? Let us know your thoughts in the comments down below. And speaking of cypherpunk ideals, if you want to learn more about which cryptos can freeze your wallets, then check out this video right over here. That's all for now though. As always, thank you for watching and I'll see you next time. This is Guy, over and out.